Hello and welcome to the Finance Talk. Today I'm going to discuss with Christian Gatteke, Head of Research and Investment Solutions, whether the next financial crisis is already around the corner.
We think it's extremely difficult to predict crises. These are unusual events and it's almost impossible to forecast them. I would simply remind investors that the last financial crisis, a smaller one, a shock, is not that long ago. That was the breakdown of commodity markets in late 2015, early 2016. So, these things are with us and will stay with us. We don't think and we don't see anything around the corner.
Now, you analyzed the volatility of the S&P 500 index going back 90 years, and you analyzed that on average every 3.5 years there's a crisis. You also, in your latest research viewpoint, analyzed that there is a minor financial shock or shouldn't happen before 2019, and the major systemic crisis won't happen before 2025. How do you get at these exact years?
Well, first of all, these are averages so that you get a feeling, how often these crises actually hit. And, if you take the 2015, 2016 experience and extrapolate 4 years, then you end up at something like 2019, 2020, which, by the way, is also the time by which our economists expect the next recession to happen. So usually recession are triggers for such a crisis to evolve. But of course, you can't set the alarm clock every 3.5 years and expect that there will be a crisis there. But there seems to be a natural rhythm. And when it comes to the bigger ones, they're, of course, unfortunately, a lot more rare and seldom. But there it's more like one generation, which is every 20 years. So a big one is hitting. And this is a one that people will talk about for the rest of their lives.
Now, talking about financial crisis, rather than looking at patterns, shouldn't we look at the causes, what caused the past crises? The famous professors, Harvard professors Reinhardt and Rogoff, identified 4 major criteria. Can you elaborate on those a bit?
Yes, indeed. The fundamentals, of course, matter, but that's like, forecasting an earthquake. You always know where the fault lines are and, whether there's activity or not. Whether you can forecast for that when actually an earthquake is happening, that remains questionable. I mean, what Reinhardt Rogoff did in their kind of most famous work and most broad-based work on the topic is they looked at issues which are some precursors of crisis, and there you can identify some. One of them is capital flow related, so a capital flow bonanza, also often kind of matched with some financial innovation, asset-backed securities, new instruments that nobody's really comfortable. On the other hand, there's housing booms, which are also some warning signal, and deregulation is also one of the favorite topics ahead of crisis. So if you start deregulating, like in the 1980s, ahead of the 1987 crash, these type of things happen. So those 4 ingredients are out there, and that's usually, and again, can't really tell what the exact lead is. Is it a year? Is it 3-4 years until crisis becomes more likely? But that's when you have to get a heads up and look around what's happening.
Now, deregulation is a topic I'd like to focus on a bit. After the financial crisis in 2008, regulation in the financial industry has increased dramatically. Now I'm seeing first signs of deregulation. At the same time, finance industry or the financial titles are having a good performance. Is that potentially the area where we'll see the next crisis?
Well, possibly, and maybe that's the crisis of 2025. What Reinhardt Rogoff observed is that it takes quite a while from the deregulation until the real crisis hits. So to give an example, there was huge deregulation efforts in the 1980s under the Reagan government, and that basically, to a certain extent, triggered the savings and loans crisis, which was almost a decade later. So these cycles can be very, very protracted. And if we take the current regulation cycle, which started, as you rightly pointed out, in 2008, 2009, this is just barely at the end of the regulation cycle. So we haven't seen anything but a peak regulation overall. So, depending on how loose regulation will ever get after the experience in 2008, it will take quite some time until this is really hitting financial markets and also financial stocks.
to me, it feels a bit like people are sort of forgetting what the consequences were and starting to loosening things. I don't know, it's all to do with memory and how long people remember things. Or what's your view?
Yeah, I think, you know, this is 2008 was a once-in-a-generation crisis, and I think this is alive and kicking. The memories are there. People remember what happened. They will never forget that even a large bank, a systemically important bank, could possibly go down. So I think this is something that people bear in mind. And again, you know, this makes it quite unlikely that the history repeats itself anytime soon. You know, if you take, for instance, the Great Depression in 1930, it took almost 80 years. So basically, all the generation who went through this in their economically active time were already out of the picture until it was possible to repeat that thing. So I think, you know, we can't really expect that people forget. I mean, they forget the small ones, the shocks or so, but really the big one, the big crisis, the one defining a generation are usually very, very much alive.
And I think it's good that you remember these things because people should learn from past crises now. Now, looking at today's risks, where do you see today the biggest risks? Maybe risks that are being overlooked at by our competitors or by the consensus?
I mean, you know, if you look at what happened in the past few years as a response to the crisis, ironically, you know, the money pumping and basically the valuation of fixed income, you know, rates going to zero or even below. Some central banks actually hijacking the whole yield curve, you know, actually taking the bond market as a hostage, like in Japan. You know, these type of things actually should really kind of get you worried. But again, you know, this is like the fault lines in the seismology, where you just realize, you know, where the pressure is, but you never know whether this will give way and at what time. So I think until this really becomes kind of an avalanche type of issues, I mean, we just can't see the signs yet, you know.
So do you maybe see central banks moving out of the markets as the purchasing program being decreased? Is that a potential risk? Is that the reason why the Fed is so cautious?
Well, exactly, you know, and this is also the reason that every central banker actually would like to avoid this moment. And I think that nobody in their sane minds would ever come to the conclusion to revert this stimulus. The hope is still that they can actually outgrow this, and for pure political pressures, the Fed is basically starting really a very, very gradual homeopathic doses type of unwinding of the balance sheet. Otherwise, they would like, you know, just to use 3 or 4% of GDP of treasuries to create a usual money supply. And, you know, by 2025, 2030, a lot of this balance sheet increase would actually be absorbed by the usual activity. That would be the game plan. Nobody tries to unwind. If it happens, but, you know, no sane central banker is indicating that if it should happen in an uncontrolled manner, this would be doomsday for sure.
So what about, I'm thinking about the World Economic Report that was issued at the end of last year, where we were looking at, interestingly enough, not the economic risks seem to be at the center currently, but it's more other risks. What is your view?
Yeah, well, the Global Risk Report from the World Economic Forum is a survey-based, and they ask 1,000 risk takers, senior managers and chief risk officers across the globe what they think the actual risks are in terms of importance, but also in terms of probability. And if you look exactly as you pointed out, you know, this has shifted a lot. People, and that's again, you know, coming to the memories of the great financial crisis, people, investors in particular, but also the public opinion is still living in this financial and systemic risk world that at some stage, you know, things will fall apart. And then you turn to those who have their ears on the ground when it comes to the real risks and also have to insure. Some of them have to sell insurance against that. They just give you a completely different picture. This is about geopolitics, hard to model, hard to grasp this type of risk. On the other hand, a lot of environmental risk, weather-related catastrophes and the likes, which can be disruptive as well. But, you know, far away from this systemic mix we've been used to. And I think, you know, as usual, you just, the real things come from unexpected corners. The real surprises come from unexpected corners.
Now, when you say unexpected corners, how should investors protect from these risks? Is it actually possible to protect oneself from these kind of risks?
I think to a certain extent this is like trying to avoid pain when you do sports, you know. I mean, this is just happening and it can happen, you know, if you jog, if you cycle, you know, you will have your issues, run your risks. That's part of the game, and I think investors simply have to understand to a certain extent, you know, this is the courant normal. This is what you actually get paid for because you're able to stand in, you know, first line of defense in equities or second line of defense, and just to tolerate that things are going wrong for some time. Of course, you would like to be there when the whole thing is breaking apart, you know, but a part of that, this is daily life for investors to bear risks and be able to withstand these turmoils.
So in the end, we're saying that diversification is important. You shouldn't focus just on one area, or what would you recommend?
Well, diversification is always, you know, kind of trying to spread everything, that nothing really matters. But the trouble is, you know, if bigger things happen, you know, if you see like geopolitical risk escalating, I think, you know, there's just no place to hide. You know, if somebody pushes the button, it's just hard, even after being diversified. Yeah. Of course, you know, we always preach not to put all the eggs in one basket, to have some alternative types of risk and have some gradualism as well. Of course, this always makes sense. But I mean, let's be frank, you know, you can't protect yourself against anything and always have like a fully insured portfolio against any market outcome. That's really hard to achieve if you want to have a rate which is acceptable.
So no return without taking at least a bit of risk.
Exactly.
Thank you, Christian. And thank you for watching. We look forward to bringing you more insights into the world of finance soon. Bye for now.